SRB Legal is a commercial law firm with a specialist financial services team. That team has seen a significant increase in the amount of work it undertakes on behalf of businesses who have been sold interest rate protection products by banks. This video with Max Hotham will give an outline as to how hedges work, focusing on interest rate swaps and the common complaints SRB Legal is dealing with in relation to the sale of them.
There's a number of derivative products. We've got plain vanilla interest rate swaps, caps and collars, callable. There's even a roller coaster interest rate swap, but certainly the one we're dealing with the most is the plain vanilla interest rate swap. They've been around for a fair while, but traditionally they were used by sort of sophisticated investors. For example, a commodities dealer might hedge an exposure to a fluctuating currency. So where they buy a product in one currency, sell in another, obviously there's a potential exposure there. The difference, of course, with the sort of client we're dealing with now is that the people who originally had hedges were sophisticated. They knew what they were doing, and they had a team of, whether it's accountants or a finance director or something like that, to talk them through it. Now, the people we're dealing with now are not sophisticated financial investors. They haven't got the luxury of this team of advisors behind them, and they're not necessarily aware of the risk of these derivatives when they enter into them. And what we've seen is that banks are more sort of aggressively marketing these things to further down the food chain, and that seems to have caused a number of problems. So whether as a precondition for new borrowings, so the bank is saying if you want to borrow this £1 million, you need to have a hedge, or whether the bank's approached the customer and said, this is something you need to think about with your existing borrowings, the net effect's the same. You have an individual or a small business ends up with a hedge or with a derivative product. So let's see how a plain vanilla swap works. For a swap to be put in place, you obviously need a high street bank. The bank will lend money to its customers, with the repayment being on a fixed rate basis or a floating rate basis, or sometimes a combination of the two. In this example, we're using a loan that is purely on a floating basis. The reason being that where a loan is on a fixed rate, the customer has no exposure to an increase in base rate, i.e. they pay the same irrespective of what base rate does. As a result, there is no need for a hedge in these circumstances. With a number of new loans, hedging was a precondition of the loan being sanctioned. So the bank is effectively saying to the customer, unless you hedge, we won't lend you the money. In other cases, where the customer already has the borrowings, they are approached by the bank on the basis that they are exposed to an increase in base rate. In return for their loan, the customer will repay the bank the loan and pay interest linked to base rate. In addition, the customer will be charged a margin, let's say 2%. So to recap, the customer is repaying the capital plus base plus the margin. In order to sell the hedge to the customer, the bank will introduce them to its treasury department. Under a swap, the customer will pay a fixed payment of X percentage to the treasury department. The precise amount is calculated by reference to a hypothetical notional amount. This notional amount should have some bearing on the loan and should reduce in line with the loan being repaid. This payment is made either monthly or quarterly. In return for this payment, the treasury department will pay the customer a floating rate based on the average base rate during the relevant monthly or quarterly period, as the case may be. As you can see from the diagram, the customer is paying the bank the loan plus base plus its margin. But the customer is receiving base rate from the treasury department, so in effect these two cancel each other out, leaving the customer paying X percent to the treasury plus the loan and the margin to the bank. It's important to remember that the loan is completely separate to the hedge, and the hedge has no bearing on repayment of the loan. Only the interest will be affected by the hedge. If base rate has gone higher than the fixed rate under the swap, the customer will receive money from the bank's treasury department. This is because the customer will remain paying X percent to the treasury, yet will receive back an amount linked to the average base rate during the relevant period. Although the customer's payment to the bank will have also increased, this increase will reflect the increase in the payment the customer receives from the Treasury Department. Where base rate falls, as has been the case recently, the opposite effect occurs. The customer continues to pay the same fixed amount to the Treasury Department, yet receives a smaller amount in return. The effect of this is that there is a net payment to the Treasury from the customer. Again, the customer will end up paying less to the bank given the decrease in interest rates. Going back to my point about the fixed rate loan, it begs the question, if the bank was concerned about the customer's ability to repay its loan if base rate went up, why wasn't a fixed rate loan made available? This will have exactly the same effect, but as you can see, it is infinitely more straightforward. So where we're seeing problems as having arisen is on a number of fronts, one of which is exit fees that are applicable should the clients wish to come out of the swap prematurely, so before the end of its fixed term, if you like. So what we're seeing, the exit fees with base rates having fallen dramatically, and with a number of these clients tied into long-term products, is that the exit fees are significant compared to the underlying loan. The second issue we're seeing is the mismatch between the hedge and the loan itself. So whether that's a mismatch between where the loan is to be repaid over 5 years but there's a 10-year swap, or the notional amount of the hedge compared to the actual amount of borrowing, so the notional amount is far higher than the borrowing, or even some difference between where the borrowing is linked to base rate and the hedge is linked to LIBOR. So there's a clear mismatch there, and the hedge is designed to protect, and it's fundamentally failing to do that in some circumstances. Clients are also encountering problems where the loan has been repaid in full, so whether that's the swap was linked to a property that's been sold or the underlying business has been sold, the borrowing no longer exists, but they're sort of lumbered with this hedge that's protecting them from borrowings they don't have. The fourth problem we're finding is where the product has been sold as something that's flexible. This is something that's portable, that can be moved between banks and can be exchanged readily. But what we're seeing increasingly is in the current climate, the banks aren't willing to take these things on. So what was sold as a highly portable object is actually a bit of a millstone around the neck that prevents the client from refinancing elsewhere or seeking alternative borrowings. Since 1st November 2007, the Conduct of Business Sourcebook has governed the sale of these products. Now, COBS 4 states that a firm must ensure that communication is fair, clear and not misleading. Now, this will cover promotional literature, the phone call during which the hedge was entered into, etc. And what we're finding, again, as touched upon previously, is that exit fees, for example, were not properly explained to these people, and they were simply unaware of the risks that these products entailed. COBS 9 deals with suitability. Now, as we've touched upon previously, the customers these are being sold to, whether as a precondition or whether as a recommendation in relation to existing borrowings, they weren't sophisticated people, which raises the question of suitability, and on the face of it, these things may not have been suitable from the outset. COBS 10 deals with non-advised sales and governs the appropriateness of the product. Now, even where the bank isn't making a recommendation, they still need to ensure that the advice and the information they provide the customer with is appropriate and that they understand the risks. And again, going back to what we said previously, it seems as though this wasn't always done. The clients we see as regards interest rate swaps tend to fall into one of four categories. The fourth category is where there have been technical regulatory breaches in connection with the sale. We suspect these clients will probably have the most difficulty in mounting a successful challenge. The third category is where there have been substantive breaches, so these are obviously more serious breaches of the framework in which the banks are supposed to operate. The second category is where there have been substantive breaches, but in addition it appears the wrong type of product has been sold. So the client has ended up with an interest rate swap where perhaps a different type of hedge might have been more appropriate, or again, there might have been a mismatch as regards the borrowings and the hedge, or the term of the hedge and the term of the borrowings. The final category of client are those where the product was fundamentally unsuitable. So the client was unsophisticated and never really understood what they were entering into, coupled with serious flaws in the sales process, and these are the cases we're most optimistic about. At SRB Legal, we're equipped to deal with customers in all four categories. If you want to give us a call, please do. We'd be happy to conduct an initial investigation of your circumstances.
To contact the team at SRB Legal, please call 01633 817 033 or visit us at www.srblegal.co.uk. SRB Legal, Lawyers for Business.